In this video, we'll cover just how valuable automated tax loss harvesting can be for your investment portfolio. If you're not yet using an app that does it for you, you'll want to after this video. Most robo-advisors add value in automated investing, automated rebalancing, and an overall easy way to invest without any type of the traditional financial advisor aspects, right? However, not all robo-advisors offer automated tax loss harvesting. At Wealthfront, we've long said that tax loss harvesting is the most compelling reason to use a robo-advisor. Tax loss harvesting can lower your tax bill and boost your after-tax returns with no extra effort on your part. And it's a task perfectly suited to software. We think it's important to consistently publish the results of Wealthfront's tax loss harvesting service so that you can understand the benefits of investing with us. On average, our tax loss harvesting increased clients' after-tax returns by 1.8%. In this video, we'll look at how the service performed in 2021. Overall, 2021 was a pretty good year for investors despite being the second full year of the COVID-19 pandemic. And while tax loss harvesting is often associated with market declines, we're thrilled to share that Wealthfront's tax loss harvesting once again generated significant tax savings for our clients, even in the year when the market had strong returns. On average, Wealthfront clients with classic and socially responsible portfolios with a risk score of 8 who began using tax loss harvesting in 2021 received an estimated after-tax benefit worth 4 to 9 times our annual advisory fee last year. Let's take a step back. Tax loss harvesting is a tax minimization strategy that involves selling investments that have declined below their purchase price and then replacing them with similar investments. When you do this, your portfolio keeps the same general risk and return profile that you started with, but you get to realize or harvest a loss. At tax time, you can use your harvested losses to offset capital gains and up to $3,000 of ordinary income for the year. Let's look at an example with the two most common ETFs used for the US asset class, VTI and SCHB. We're not recommending these securities, but instead using a simple example. Let's say you buy VTI for $200, and a week later, it's down to $190, which is not all that uncommon, right? You can leave it alone, and sure, it might be back up in the near future, who knows? Or you could sell VTI, recognize the $10 in losses, and then buy SCHB with the $190 in proceeds. If the US asset class overall goes up, SCHB will provide a similar return as VTI. Expand those numbers out to hundreds of ETFs, and you'll start to see where those harvested losses can really add up. To measure the benefit of Wealthfront's tax loss harvesting, we use what we call harvesting yield. Harvesting yield takes the amount of harvested losses in a given year and divides the number by the portfolio's value at the beginning of the year. We calculated the harvesting yield for the average client with a classic or socially responsible portfolio who began using tax loss harvesting in 2021 and had a risk score of 8. On average, we harvested losses equal to 4.76% of their portfolio value last year. This translates to an estimated after-tax benefit worth between 1.19% and 2.38% of their portfolio value, depending on their tax rates and ability to use the losses. Put another way, this is between 4 and 9 times the advisory fee that Wealthfront charged of 0.25. Now, this table shows the average annual harvesting yield for each portfolio risk score and client vintage, which is determined by when the client first started using Wealthfront's tax loss harvesting. We included clients with unmodified classic portfolios and socially responsible portfolios, which were launched in September 2021, by the way, in this analysis. A client who began using tax loss harvesting in a classic portfolio in 2018 and then switched to a socially responsible portfolio in late 2021 would be included in the 2018 client vintage, for example. As you can see, our software harvested a significant amount of losses for clients across risk scores and client vintages in 2021, even though the market was up. We excluded the 2012 client vintage from these calculations because we launched the service late that year. And while this chart combines classic and socially responsible portfolios, we also conducted a separate analysis of the harvesting yield for clients who signed up for a socially responsible portfolio after we launched them in September 2021. The results were nearly identical. The dollar-rated average harvesting yield across risk scores for socially responsible portfolios from September 21st, 2021 through December 31st, 2021 is 2.76%. The dollar-rated average for classic portfolios of the same time period was about the same at 2.70%. If you made it this far, hit that subscribe button. You're gonna like our content. Let's talk about the factors that impact how much benefit you'll get from tax loss harvesting. And these numbers are just averages, so you could receive more or less benefit from tax loss harvesting depending on your particular situation. There are some key factors that impact how much you'll get from tax loss harvesting. First off, the riskiness of your portfolio. Riskier portfolios are generally more volatile. More volatility in your portfolio's value typically means there are more opportunities for our software to harvest losses. That said, we don't think it's wise to increase your risk score for the purpose of harvesting more losses. Don't do that. Deposit timing and add-on deposits. In order for our software to harvest a loss, an investment in your portfolio must decline below its purchase price, right? If you make one deposit and then never purchase additional investments, it becomes harder to harvest losses over time because markets tend to rise over the long run. However, if you make frequent add-on deposits, there will be more tax loss in your portfolio, and it's more likely that our software will be able to harvest losses. Your marginal tax rate. Your after-tax benefit from tax loss harvesting is a function of your marginal tax rate. We estimate the range of possible after-tax benefit by multiplying harvesting yield by 25% and 50% to approximate the range of marginal tax rates that you could pay. If you live in a high-tax state or are in a higher tax bracket, you're likely to get more after-tax benefits from our tax loss harvesting than if you live in a low-tax state or in a lower tax bracket. However, you will receive significant benefit even if you live in a state with no income tax. Your ability to use the losses. Depending on the amount of capital gains that you realize, you might not be able to use all of your harvested losses in a given year. That's okay though. Unused losses just roll over to the next year. You can also use harvested losses to offset up to $3,000 in ordinary income each year. So you don't need to realize capital gains for tax loss harvesting to actually lower your tax bill. Wash sales. Occasionally, some of the benefit of tax loss harvesting can be lost due to wash sales. A wash sale is when you sell and buy a substantially identical security within 30 days. It doesn't matter if the purchase and sale happen in different portfolios held at different institutions. It's still a wash sale. Wash sales happen pretty rarely at Wealthfront. Typically, they affect about 0.15% of trades because our software is designed to avoid them across all of your accounts with us. If a wash sale does occur, it's not the end of the world. You just have to wait a year to realize the loss. Suitable alternates. Not all the investments available at Wealthfront have a suitable alternate ETF for tax loss harvesting. If you customize your portfolio with investments that have no alternates, your portfolio's overall harvesting yield is likely to be a bit lower. You can always check to see if an ETF available at Wealthfront has a tax loss harvesting alternate by searching for specific investments here. There's a common misconception that tax loss harvesting is just a form of tax deferral and is not valuable because you have to pay up eventually, right? This is wrong for two reasons. First off, tax loss harvesting lowers your taxes through what's called tax rate arbitrage. You can offset short-term capital gains, which are currently taxed at a maximum federal rate of 37% today, and then pay long-term capital gains rates, which currently top out at 20% at the federal level when you eventually sell your investments in the future, as long as you hold them for at least a year. Second, tax loss harvesting also lowers your taxes through the time value of money. In other words, you come out ahead because it's more expensive to pay taxes today than it is in the future. At Wealthfront, we use software and automation to save you time and hassle. It's true that you could conduct tax loss harvesting yourself, that's true, but it would take a lot of effort, and software does a way better job. That's because you're highly unlikely to look for opportunities to harvest losses every single day. But software can check for these opportunities on a daily basis, which leads to greater benefit. We're super proud to make our tax loss harvesting available in all taxable investment accounts at no additional cost. We know of no other robo-advisor that publishes its tax loss harvesting results, which we think might tell you something about how their service performs. Thanks for watching. I'm Tony from Wealthfront. Take care.